A lot of buyers think the biggest factor in buying a home is how much income they make. But some of the people with the highest incomes that we talk to aren't always the ones with the most buying power. And that's where things get interesting. What's going on, everybody? Welcome back to another episode of Closing the Deal. I am one of your hosts, Sam Enright, and sitting across from me is my co-host, Zach Dixon. And yeah, guys, we're just going to address the elephant in the room. You know, feels like it's been a little minute since we've actually sat down and done this and brought you guys some new content. So it may not feel that long, but it feels that long to me. So Zach, what's going on? How are you doing today, bro?
Excited to be back in the booth. Excited. I think this episode is going to be a really good one for us specifically. It's been a good talking point over the last few days, couple of weeks. I just think it's going to be a good one. So why don't you let the listeners know what we're talking about today?
Yeah, guys, today we are going to be talking about basically income, debt, and buying power, and how the three are related to each other when it comes to buying a home. As we kind of talked about in the opening there, there is a lot of times in life I've been, susceptible to the thought process as well as, as soon as I make more income, I'm going to have more buying power on certain things in my life. And, that doesn't always necessarily translate to more buying power when it comes to purchasing a home, is making more income. So today we're going to kind of address that myth a little bit. And then again, talk about the relation between income, debt, and ultimately the buying power that affords you when it comes to purchasing your home, whether that's your first home, second, third, all down the line.
Definitely. And I just think it's a big misconception, just like you mentioned, about the, raising the income. People think that the more and more we make, the more and more that we can buy, the more that we can qualify for. And again, like you mentioned, it's really just one aspect of the puzzle, one piece of the puzzle there. So definitely excited to get into today's episode, dive into it a little bit, and hopefully maybe bust some myths.
Absolutely. Yeah. So, I guess that kind of takes us directly into, the first thing that we're talking about. And, that would be the biggest myths that buyers have when it comes to this topic and when it comes to income and debt. And the first one is, more income automatically means more buying power. Again, not always necessarily the truth. It is going to be a very case by case basis. You have to look at the whole picture, right? So, we're looking at not only how much income do you make, but also we look at the liabilities that you have every month when it comes to what is being reported as debt on your credit report. So, we've seen people, I could take somebody that makes $5,000 a month gross and has very minimal debt, and somebody that makes $7,000 a month gross and has a lot more debt, and the buying powers are going to be two completely different things for each buyer, right? Even with more income. So it's not always a one size fits all, and it's not always, hey, as much income as you make is how much house you're going to afford. There's a lot of other factors that go into it. And I think the reason that people think this is ultimately, it does stand to reason. Logically speaking, you would think that the more income that you earn typically is going to allow you to, take on a higher or bigger house payment, or really anything in life, right? You're going to be able to afford more with the more income that you make. And it makes sense on the surface, ultimately, right? Because you're getting more money into your bank account every month. So logically speaking, you would think that you have more to put towards whatever that is that you are looking to purchase. However, again, we're talking about two completely different things here. Just because you have a higher income doesn't necessarily mean that you're going to be able to afford more house. It really does boil down to the relation between the income and the debt as a whole, more so than just the pure income number by itself.
Absolutely. And I mean, the caveat there too is the obligation number. Now, if you have two individuals that make different amounts of money income wise, but have the same debt obligation month over month. Obviously speaking, the one with the higher income is going to be able to afford more. But again, just like we talked about, it's a one piece of the puzzle type of thing with the income. We have to combine all of those things put together, and that's how we get that buying power number to be able to go out and shop for homes. And I think just again, a lot of people misunderstand or don't put enough weight into the fact of their monthly obligations each month and how much that goes into the buying power equation, because that's exactly what it really is. It's an equation, not just get one number and boom, we can afford this amount. So
Yeah, and I mean, I think a really good example of this is we've talked to clients several times who will say, well, I'm paying more in rent every month than I am in what this proposed mortgage payment is going to be. Or, my rent is only, a little bit less than what this mortgage payment is going to be. However, when it comes to rent and when it comes to obtaining a mortgage, we're talking about two very different qualifying guidelines. Ultimately, to rent, you are paying them a monthly amount to live in their space that is not yours, right? You're not paying them $150,000 to purchase this thing, and you're going to borrow the money from them and pay it back and then make this thing your own. It's ultimately a transaction of, hey, I need a place to live. I have money to give you for this place to live. In exchange, they give you a roof over your head and a place that you can, ultimately live in, right? The mortgage transaction is much different. You are borrowing typically 150, 200, 300, 400, $500,000 worth of money and paying that back. And the bank's their largest responsibility is to make sure that you are willing and able to pay that debt back to them, because they are giving you an asset in exchange for that money. And so it's a much different thing. And so, we have had clients who are like, well, I'm paying just as much in rent. And it's like, yeah, but that's not exactly how it works on the mortgage side of things. If you're over leveraged on your debt each month and you are still paying your rent payment, doesn't necessarily mean that you're going to be able to afford from a lender and loan guidelines standpoint the same amount of house based on those factors when it comes to actually purchasing. So it is a very different thing. And you have to look at, again, the relation between the income and the obligations and figure out and make sure that we're going to meet loan guidelines, because they don't just let you borrow up to 90% of what you're making every month to pay your mortgage, pay your debts, and have 10% of your income left over, right? Or else we'd have a lot more people that are underwater on their mortgages. That's just reality. There's a reason those regulations are put into place.
yeah, good points there, brother. And to wrap up that segment, obviously, your rent payment isn't it is a monthly obligation, yes, but it does not show up on your debt report, your credit report. That's not something that's going to show up in those debt to income ratios, whereas a mortgage payment absolutely will. So just have to kind of differentiate the two and make sure that we're thinking about those two things separately as a whole. And so moving on, guys, to our next segment here, just talking a little bit about, what the monthly obligations are, what those payments are, and sometimes, the payments that people forget about as a whole. Again, when we're talking about monthly debt obligations and what is used to calculate that debt to income ratio that allows you to be qualified for a mortgage, it's going to be all of those things that do show up on the credit report, unlike your rent payment. It's going to be car payments. It's going to be student loans. It's going to be personal loans. It's going to be credit cards. It's going to be financed toys, financed, anything financed are going to be included in those monthly obligations. So when you do go talk to a lender, obviously at that point, that is going to be, a big talking point to determine how we can figure out that buying power number. You're going to fill out an application. You're going to list all those things out. And ultimately at some point in time, when you get into contract and do all that, we're going to need documentation on those things and be able to determine those things as well. And I was actually just talking with a client the other day, just to make sure that that people are understanding that these are monthly obligation numbers that go into the debt to income ratio. It's not necessarily the full balance of these loans themselves, but it is the monthly obligation. So if you owe, $100,000 in student loan debt, it's not necessarily the $100,000 that's going into that monthly debt to income ratio. It's what you are obligated to pay on a monthly basis. And that is how that debt to income ratio is calculated. And so it's not always about what you are earning. It's really just about what you have outgoing as well in conjunction with what you have incoming. And so we have to just trying to make sure that we reiterate this point throughout this episode, that there are just two parts to the equation, and you can absolutely increase your income to change one part of the equation, but you can also at the same time decrease that debt. And at that point, you're changing two parts of the equation and starting to increase that buying power on both sides of the equation as a whole. So
Yeah, absolutely. And kind of wanted to touch base on a couple of those things in there that you talked about, because I think for most people, some of those are a little obvious, maybe some of them not so obvious. But there's, subsections within those, right? So for the student loans, I know you mentioned that, people will say, well, what if my student loans are deferred? Well, most loan guidelines have a specific calculation that you do for deferred student loan payments. So if you do not have a minimum monthly obligation, a minimum amount that has to be paid on those, FHA takes 0.5% of your total balance to create a monthly payment for that. Conventional Fannie Mae is the one that does 1%. So if you have a $20,000 student loan debt, your monthly obligation on our side, when we are running your debt to income ratio and running your configurations for your loan, it's going to be a $200 a month minimum payment, right? So whether or not it's deferred or not doesn't necessarily mean that is automatically going to be removed from consideration in your debt to income ratio. So something to be mindful of is that, even with no minimum payment on those are still taken into consideration by different, every loan guideline has a little bit of a different number that they use, but still it is something that is factored into there. And then, another, what I would call a silent killer would be collection accounts. Most people don't know that most loans, if you have a collection over $2,000 or you have cumulative collections over $2,000, they do require that we take 5% minimum of that balance and hit your debt to income ratio for that. So if you have a $5,000, collection, that payment, I'm not good on the quick math there, $250 a month. Yeah. So $250 a month right there, that's going back in for something that you're probably not paying on. Maybe you didn't even know was on your credit, or maybe it's been on there for 4 or 5 years, so those things do impact your buying power when it comes to a mortgage. And then furthermore, through that, there's other liabilities as well. So all those things are typically things that are going to come back on a credit report. However, if you owe the IRS money and you're in some sort of payment plan back to them to pay back your tax obligation, that is something that would be taken into consideration, debt to income ratio. Child support, if you pay any of that, alimony, those sort of things are documented and also hit into your debt to income ratio as well. So things to certainly be mindful of. And then another one that we actually have seen pop up here recently over the last couple of years is as these Klarna, Affirm, and these one-time, or not these one-time payment systems, but these payment systems that allow for longer pay. Maybe they don't always report it to the credit report. And if we see, those sort of charges recurring in a banking, we will document that and make sure that that is not a true installment debt, because I do know that, like Affirm in these places, they do allow for longer terms now. I know a lot of their initial stuff was, okay, you can pay if you buy a product for $200, you can make 4 interest-free payments. But I do know that they do allow for longer financing options as well. So those sort of things have come up as well here recently as they have become more popular amongst consumers. So that is something to be mindful of as well when it comes to your debt to income ratio and total obligations monthly, because it is, they do look through everything, and they do make sure that, whatever is going out is being taken into consideration.
No stone unturned. That's for sure.
100%. So, and I guess I like to leave you guys with this before we move on to the next segment. This is always a good question to ask. And, maybe we'll come back with the answer later. But if I were to raise someone's income by $1,000, would that offer them more buying power than reducing their debt by $1,000? I think that's a good one to kind of chew on, because I don't know that most people would think that. I think I know where most people's answer would be, but I think that they would be incorrect.
Couldn't agree more. Could not agree more.
So getting into kind of the next thing, which I guess we really did just obviously kind of go into some things here that would surprise most buyers, but debt that kind of comes up, and again, things that maybe you're not thinking about in the moment, but that do come up. One thing that we see a whole bunch is expensive car payments. That is, I mean, you can look up the numbers. I'm pretty sure the average car payment in the United States right now is like $700. So, that's a large chunk of your debt to income ratio going out towards one debt in particular, before we take into account credit cards, personal loans, anything else there.
This is a crazy one, to be honest with you. I really can't comprehend how somebody would be surprised by taking out a large, expensive vehicle, loan, and having that payment. You're very conscious about the payment each month, I think, when you do go to sign those loan documents for an expensive vehicle. But I think it very much surprises me that somebody would be surprised that this isn't a inhibiting factor to, not being able to qualify for a larger home purchase, because I am forking out, $600, $700, $800 worth of car payment on a monthly basis. It just, maybe it's because of the industry that I work in, or being a little bit more financial, tied in with the financial side of things as a whole. But I can't comprehend for the life of me how this would be a surprise, because again, you do sign the loan documents, and it is an obligation each month. But it absolutely does surprise people that, it's a prohibiting factor in not being able to afford more home than what you could if you did not have this large, expensive vehicle on your credit.
Well, and I think it goes back to the question that I just asked. If you were to raise income by 1,000, or you were to decrease debt by 1,000, which one would be more impactful in your debt to income ratio, in your obligation as a whole? I think most people would say, oh, it would probably even out, right? That's not the reality. The debt, wiping out the debt, would have a far larger impact on your overall debt to income ratio than raising the $1,000. So most people, I think, when they think about their income in relation to what they're paying, they don't necessarily take that into account, because again, it's back on the same rent thing. It's, well, I'm paying the debt, I can afford to pay it every month. And I think that that's the lens that most people look through. If you look at a credit report and nobody has late payments, and they don't have any sort of derogatories, and they're paying their bills on time, and they have a $2,000 a month rent payment, and you're looking at qualifying them for a $1,700 a month mortgage, I think most people would be utterly shocked when it comes to the fact of like, well, depending on debts, you may not be able to afford that on paper. Just because you're paying $2,000 in rent every month doesn't necessarily mean that you're going to qualify for a $2,000 a month mortgage payment based on lending guidelines, right? So I think that's where most people probably get a little shocked when it comes to those things, is like you mentioned, they're not forgetting that the debt's there. I think they're not realizing the amount of impact that large of a debt can have on a debt to income ratio in relation to, the income being earned ultimately.
Absolutely. Absolutely good points there. And I think that honestly just kind of takes us into, the next segment of today's episode. And that's really what buyers can control. And that is, having awareness of what they're taking out on a monthly basis, and having awareness of what that actually does when they go to sign those papers. And ultimately, having a plan for down the road, ultimately, when we do want to buy a home, knowing that this is going to affect that as a whole as well. So the things that obviously buyers can control is paying down debt more than necessarily what the minimum payment is itself. It's a great strategy to be debt free, and ultimately will open up a lot of doors and a lot of opportunities for you as an individual if you are debt free. And like I mentioned to begin with, the planning ahead aspect of it, if you know that you're looking to buy a home in the next 2, 3, 4 years, maybe buying that expensive car right now is probably not the very best move you can make to kind of set yourself up on that path of being able to buy the home that you're looking to buy in 2 to 3 to 4 years. I think that when we make those decisions, having the lens of being able to be a little bit more forward looking, and be able to make those decisions based on the plan that we have ahead, it will allow us to have a little bit more success, in my opinion, and be able to, achieve the goals that we want to achieve as a whole. Another one's going to be avoiding unnecessary financing. And a good example that you just used was the buy now, pay later, big old thing that's going on nowadays. Everybody's using it. Again, if you can't afford to buy it in cash at this very moment, you probably don't need it. Just depending on what the example is, it's probably good for about 90% of things. Obviously, there's going to be, unexpected expenses and things that may need to be financed. But now we're going down another path of having an emergency fund in place and whatever. We'll not go that far into today's episode. But again, just avoiding unnecessary financing is going to be a big one, and it is usually something that is within our control 100%. Again, just finishing up, understanding where you stand as a whole all the time is a very, very key aspect of your debt to income ratio, of your buying power. Just knowing what is on your credit report and how much those monthly obligations are each month definitely makes a difference when you go to have that strategy, when you go to have that plan of buying the home in the future, whatever time frame it is. Again, just all of these things that are within the buyer's control and that you can, influence to make sure that you're on the correct path of wanting to buy that home in the future.
Yeah, for sure. And I think, a couple of big points in there, right? It's we're not trying to be perfect. Ultimately you just want to bring awareness to these things and understand, and I use the example of the rent and all that stuff, not to necessarily deter people from thinking that they can't buy, but just understanding that the relation is not always the exact same when it comes to renting and when it comes to purchasing. There are different regulations put in place when it comes to obtaining a mortgage. And you have to be able to look at the full picture and understand why things are happening the way that they are when it does come to qualifying for a mortgage versus when it comes to maybe signing yourself up for rent or those sort of things. And Zach hit on a couple of good points there. My own personal story is, I've been in personal debt since I was 18 years old. And so I've worked like hell to try to get out of that myself personally. And, it's a grind. It's a challenge. I don't think we're going to sit here and make it seem like, we obviously are not, what's the word? We're not blind to what's going on in the world. I mean, consumer debt's up over several trillions of dollars. So I know that, groceries, all those things, they're expensive, and it is just the reality of the world that we're living in. And so, unfortunately, we have to try to make as best decisions as we can. And sometimes there's going to be things that pop up that are outside of our control that we don't, that we need to, maybe finance things, and we need to put, those things on credit cards or whatever the case may be to kind of live and get through. But ultimately, it comes back to that having awareness, right? And sitting down and creating a plan and having a strategy when it comes to debt. And then also, when it comes into relation of buying a home. And, I think that's what makes my personal opinion, what one of the things that I really enjoy about this business and I enjoy about working with clients is actually being able to help guide them in that manner and not just be like, hey, your debt's, where it is and your credit's where it's at and there's nothing that we can do. So, kind of go figure it out and come back. That's not the approach that we take. We are very much so very willing to work with people and, kind of give them the information, the tools that they need to ultimately, improve whatever situation they're in to get themselves in a position to buy or obtain whatever goals it is that they're looking to obtain. So, I don't want anybody to listen to this episode and think that, we're asking for perfection. I obviously understand, and we understand that that's not the reality of life, but there are ways to mitigate some of these things and keep a little bit of this stuff off of the books when it comes to unnecessary financing, for sure.
Absolutely, brother. Absolutely. And I think just kind of wrapping up, we've talked about it ad nauseum here in this episode, but the biggest lesson that we want to kind of hammer home to the listeners is that your buying power is, again, not just income. It's one part of the equation, the income is, but we have a part of the equation, and that is the debts that we have and the monthly obligations that we have each month too. So again, I think the misconception, the myth that we came into the episode with was the more income we make, the higher buying power that we have. And while that can be the case, absolutely, but it's also not taking into account the other part of the equation, the monthly obligations. So if we have a lot of income, but we also have a lot of monthly obligations on the debt side, the buying power is going to be a lot lower than I think most people would think it is, just solely based on what they make and the income that they make. Again, it's your buying power is your income, your obligations, and to be able to plan over those time periods as well is going to be a big key when you do have that buying power calculated and put in front of you when you go to buy a home.
Yeah, for sure. Couldn't agree more, man. I mean, obviously, a lot of people spend a lot of years focused on just, I'm going to make more income, I'm going to make more income, I'm going to make more income. And that I would certainly never deter anyone from reaching for that goal. I think we should all be looking to progress and make more income as the years go on. But ultimately, with more income, trying to limit those debt responsibilities, those liabilities, is going to have, in my opinion, a far greater impact on what you're able to do, the buying power you're able to have when it comes to your home. And I think just buying power in general in life, for any opportunities that may pop up if you are not over leveraged and putting yourself in a position where, you have half as much debt as you are making income. It's always going to be better to have less debt than have more income, in my opinion. So obviously having more income, having less debt would be the perfect storm right there, of where you'd want to live in.
Absolutely. Simply keep more of your money readily available. That is the name of the game, 100%.
Absolutely, man. Well, yeah, guys, kind of a little quick one for you guys today. So always happy to be back. And as you guys know, yeah, we drop episodes every Friday, noon Eastern, on YouTube for video and audio, and then audio only on the Apple and Spotify podcast platform. Go check us out. We're on Instagram, Facebook, YouTube as well. So please feel free to subscribe, give us a follow. Appreciate you guys for tuning in as always. And we will see you guys again here coming up in the next couple of weeks.